Hi friends, in this module we are going to discuss on chapter 3, question number 26 to 30. First, coming to question number 26a. A and B are partners sharing profit and losses in the ratio of 3:2. Goodwill appears in their balance sheet at 24,000. When C is admitted into partnership for 1/5 share in profit, he pays rupees 50,000 for capital and rupees 8,000 as goodwill. The ratio of the partners A, B and C in the new firm would be 2:1. Pass journal entries in the books of the new firm to record above adjustments. So we have two partners, A and B initially. They share profit and losses in the ratio of 3:2. C is admitted as a new partner for 1/5 share of profit. C brings 50,000 as capital and 8,000 as goodwill. The new profit sharing ratio between A, B and C is 2:1. Also, we know there is goodwill in the books, that is goodwill in the balance sheet. We have 24,000. Okay, first we need to find the sacrificing ratio. So here A, his original share was 3/5. He sacrificed, his new share is 2/5. So it is minus 2/5, which is equal to 1/5. Then P, his original share is 2/5 minus 2/5 itself. His new share is 2/5 again, which will give 0/5. So here only one person sacrificed. A sacrificed. For B there is no sacrifice at all. A sacrifice is 1/5. Now we need to pass journal entries. Okay, so we have first journal entry is in the books there is an existing goodwill of 24,000. This has to be written off. So the journal entry for that is A's capital account debit, B's capital account debit to goodwill. So we know the goodwill appearing in balance sheet is 24,000. We wanted to understand the debit amount. So we need to distribute this 24,000 in the partners' old profit sharing ratio. So that is 3:2. Now if it is divided, it is going to be 14,400 and 9,600. Now the new partner C is bringing in capital and goodwill. For that, bank account debit, his capital is 50,000, goodwill is 8,000, so its debit is 58,000 to C's capital 50,000, then to premium on goodwill 8,000. Goodwill bought by the new partner has to be distributed to the old partners in their sacrificing ratio. So here only one partner sacrificed, which is A. So premium on goodwill debit 8,000 to A's capital 8,000. So that's because A is the only one who sacrificed. Okay. Then let's move on to question number 26b. A and B are carrying on business as partners, used to share profit and losses. Thus A 4/7, B 3/7 and goodwill appears in the books of the firm at 2,80,000 when C was admitted as a partner having 1/7 share in the profit and losses. C was asked to pay a premium of rupees 75,000 goodwill and the profit sharing ratio as between A and B remain unchanged. Okay, now let's look at this question. Here we have two partners A and B. Their profit sharing ratio is 4/7 is to 3/7, which is 4/3. Then there is goodwill appearing in the books of the firm. Goodwill appearing in the balance sheet, that is 2,80,000. C is admitted as a new partner for 1/7 share of profit, for which he is going to bring 75,000 as goodwill. Now we need to find, after giving C's share of profit, what will be the remaining share of profit. So remaining share, assume that the total profit of the firm is 1 minus C's share of profit, which is 1/7. That will give you, it is 7 minus 1/7, that is equal to 6/7. So the remaining share of profit is 6/7. Now this has to be divided by A and B in their existing profit sharing ratio. So A, it is going to be 6/7 into 4/7. 4/7. So that is equal to 24/49. Then we have B, his remaining share 6/7 into his old share, which is 3/7. That is equal to 18/49. Now we know C. C's share is given in the question, which is 1/7. If we wanted to keep the same denominator, it is going to be 7/49. So we got the new profit sharing ratio of all the partners. Now let's look into the journal entry. First, there is an existing goodwill in the firm which is 2,80,000. So we wanted to write it off. So how we will write it off? We will write it off to the existing partners. Okay. So A's capital account debit, B's capital account debit to goodwill. So goodwill is appearing as 2,80,000. So if you divide in the existing profit sharing ratio, which is 4:3, it is going to be 1,60,000 and 1,20,000. Then the new partner is bringing in goodwill. He is bringing goodwill of 75,000 here. So we need to generalize for that. That is bank account debit to premium on goodwill. That's going to be 75,000. So this goodwill bought by the new partner has to be divided among the old partner in their sacrificing ratio. So it is premium on goodwill account debit 75,000 to A's capital to B's capital. Here the sacrificing ratio is same, it is 4:3. So it's going to be 42,857 and 32,142. Okay, now let's move on to the next question. Question number 27. A and B are partners sharing profits in the ratio of 4:3. C is admitted into the partnership, and the new ratio is determined at 3:2:1. C does not pay anything for his share of goodwill. On C's admission of firm's goodwill was valued at 84,000. Okay, so we have two partners here, A and B. Their profit sharing ratio is 4:3, and C is admitted as a new partner and we need to determine his share of goodwill, and then firm's goodwill is equal to 84,000. And we know the new profit sharing ratio between A, B and C is 3:2:1. First, we need to find the sacrificing ratio. For A, it is 4/7, which is his original share, minus his new share, which is 3/6. That is equal to 24 minus 21/42, which is equal to 3/42. Now B, for him, his original share is 3/7 minus his new share, which is 2/6. That will give you 18 minus 14/42. That is equal to 4/42. Okay, so now we know the sacrificing ratio between A and B is 3:4. And we also know the firm's goodwill. Firm's goodwill here is 84,000. Now we need to find the goodwill that's the new partner C has to bring in. So C, his goodwill is 84,000 into 1/6. So his goodwill is 14,000. Why 1/6? It's the profit sharing ratio of C. 84,000 is the total goodwill of the firm. Total goodwill of the firm multiplied by C's profit share. That is 84,000 into 1/6. It's 14,000. Now we need to pass the journal entries. So first journal entry is that C, since C is not bringing goodwill as in cash, it is going to be C's current account debit to sacrificing partners capital account. So A to A's capital to B's capital. It's going to be 14,000, and the sacrificing ratio is 3:4. So it's going to be 6,000 and 8,000. Okay, now let's move on to the next question. Question number 28. A and B are partners sharing profits and losses in 3:2. They admit C into partnership for 1/5 share in the profit. C pays in cash rupees 40,000 for his capital. Goodwill of the firm is valued at rupees 25,000, but C is unable to bring his share of goodwill in cash. Pass necessary journal entries. Okay, now we have two partners here, A and B. Their profit sharing ratio is 3:2. And C is admitted as a new partner for 1/5 share of profit, and he brings in capital rupees 40,000, and he is unable to bring anything in cash as goodwill. However, we will have to calculate his share of goodwill. Okay, so first thing is we need to account for the capital that C is bringing in. So bank account debit 40,000 to C's capital 40,000. Then C's share of goodwill that we need to calculate. So the journal entry for that will be C's current account. Since he is not bringing in money as cash, it's going to be C's current account debit to old partners capital, to A's capital, to B's capital. This in their sacrificing ratio, which we know it is 3:2. But we have to calculate what is the goodwill that C has to bring in. So that is we will calculate that C's share of goodwill is equal to total goodwill of the firm. It's mentioned in the question, total goodwill of the firm is 25,000. So total goodwill of the firm 25,000, and C's profit share, it is 1/5. So which means C will have to bring in goodwill of 5,000. So C's current account debit 5,000, it has to be shared in the ratio of 3:2. So A's capital 3,000, B's capital 2,000. Okay, now let's move on to the next question. Question number 29. A and B are partners sharing profits in the ratio of 3:2. On 1st April 2018, they admitted C as a new partner for 1/4 share. C acquires 1/5 of his share from A. Goodwill on C's admission is to be valued on the basis of capitalization of average profit for the last 5 years. Profits were year ended 31st March 2014, it's 50,000. Then all the years profit is mentioned. On 1st April 2018, the firms had assets rupees 7,000 and external liabilities of rupees 2,20,000. The normal rate of return on capital is 12%. C brings in rupees 1,25,000 for his capital, but is unable to bring his share of goodwill in cash. You are required to calculate C's share of goodwill, pass necessary journal entries, calculate new profit sharing ratios. Okay. So let's start on this question. Here A and B are partners. Their profit sharing ratio is 3:2. C is admitted as a new partner for 1/4 share of profit, which he acquires from A. 1/5 of 1/4 share of profit is acquired from A. Rest is acquired from B, because there are only two partners. We need to find how much it is acquired from B. Okay. Okay. Then the first part of the question says you are required to calculate C's share of goodwill. So to find out the goodwill, we have to follow capitalization of average profits of the last 5 years. Okay, let's find that out. Okay. So each year it is mentioned and the profit is given. Okay. So for 2014, 2015, 2016, 2017, 2018, 5 years profit is mentioned. 2014 the profit is mentioned as 50,000. 15 is 1,20,000, 60,000, 1 lakh, and 1,90,000. So profit for each year is mentioned. So let's write it down. 2014 it's 50,000. 2015 it's 1,20,000. 2016 it's a loss of minus 60,000. 2017 it's a loss of minus 1 lakh. 2018 it's a profit of 1,90,000. It's also mentioned including a gain of 40,000 from the sale of fixed assets. So there is an abnormal loss that is happening in 2015. So here this is the profit. There is abnormal loss or profit. We need to adjust abnormal loss or profit every year. In 2015, there is an abnormal gain of 40,000, which means we have to minus this 40,000 from the profit. On 2016, after charging loss by fire, so here there is an abnormal loss. If there is an abnormal loss, we have to add it. On 2017, they mentioned after charging voluntary retirement compensation paid rupees 1,50,000. So that's again a loss. So we will add it 1,50,000. So we are calculating the adjusted profit here. The adjusted profit for 2014 it's 50,000. 2015 it's 80,000. 2016 it's minus 10,000. 2017 it is 50,000. 2018 it's 1,90,000. Now we need to calculate the average profit. Average profit for 5 years is equal to 50,000 plus 80,000 minus 10,000 plus 50,000 plus 1,90,000, all divided by the number of years, which is 5. So average profit is equal to 72,000. Now we need to find the capital employed. So capital employed is equal to assets of the firm minus liabilities. So in the question it is mentioned on 1st April 2018 the firm had assets of rupees 7 lakh and external liabilities of rupees 2,20,000. So the total assets is 7 lakhs and liabilities is 2,20,000. So capital employed is 4,80,000. Now we need to find the capitalized average profit. Capitalized average profit. So we already calculated our average profit, which is 72,000. So it is 72,000. The normal return of the firm, it is mentioned the normal return on capital is 12%. So if you want to capitalize the average profit, it is 72,000 multiplied by 100 by 12. That is equal to 6 lakhs. So we have the capital employed here and we have the capitalized average profit. Now goodwill. Goodwill is equal to the capitalized average profit minus capital employed. So it is going to be 6 lakhs minus 4,80,000. Which means the goodwill of the firm is equal to 1,20,000. Now this is the goodwill of the firm. We need to find the new partner's goodwill. So C share of goodwill is equal to goodwill of the firm 1,20,000 multiplied by his share of profit. What's his share of profit? He is admitted for 1/4 share of profit. So let's multiply this goodwill of the firm multiplied by his share of profit, which is 1/4, that is equal to 30,000. So C share of goodwill is 30,000. Now the second part of the question, second part says pass necessary journal entries. So we need to pass the necessary journal entry for this. So since he is not bringing in cash as goodwill, his current account will be debited. C's current account, debit. We know the value, it is 30,000. To A's capital, to B's capital. Now we have to credit it to the old partner's capital account in the sacrificing ratio. We don't have the sacrificing ratio, so we need to calculate sacrificing ratio here. For A, the question says C's share of profit is 1/4 and he obtained 1/5 of 1/4 from A and remaining from B. So A sacrifice is 1/4, which is C share, multiplied by 1/5. That is equal to 1/20. For B, it is 1/4 minus how much A paid, 1/20. So that's going to be 5 minus 1/20, which is equal to 4/20. So the sacrificing ratio is 1:4. So now we got the sacrificing ratio, so we can fill in the remaining part of the journal entry. So 30,000, if it is divided in 1:4 ratio, for A's capital it is 6,000, for B's capital it is 24,000. Now the third part of the question says calculate new profit sharing ratios. So let's calculate the new profit sharing ratio. For A, his original share is 3/5 minus his sacrifice, which is 1/20. That will give 11/20. And B, his original share is 2/5 minus his sacrifice, which is 4/20. That gives again 4/20. Then we have C's share, which is given in the question, which is 1/4. If you wanted to keep the same denominator, it's going to be 5/20. So with this, we can find the new profit sharing ratio between A, B and C. That is 11:4:5. Now let's move on to the next question. Question number 30. PQR share profits in the ratio of 5:3:2. S was admitted into partnership. S brings in rupees 30,000 as his capital. S is entitled for 1/5 share in profit, which he acquires equally from P, Q and R. Goodwill of the firm is to be valued at 3 years purchase of last 4 years average profit. The profit of the last 4 years are 32,000, 38,000, 35,000 and 31,000 respectively. S cannot bring goodwill in cash. Goodwill already appears in the books at rupees 50,000. Okay, so now we have three partners here, P, Q and R. Their profit sharing ratio is 5:3:2. S is admitted as a new partner. He brings in capital of rupees 30,000. And he is admitted for 1/5 share of profit. The new profit sharing ratio after this is going to be 1:1:1. It's equal profit. Now we need to first find the average profit. So average profit is equal to all the profit for the last 4 years is given 32,000, 38,000, 35,000 and 31,000. So it's going to be 32,000 plus 38,000 plus 35,000 plus 31,000 divided by 4. That gives the average profit as 34,000. So goodwill of the firm, the question says goodwill has to be calculated on 3 years purchase of average profit. That is 3 multiplied by 34,000. That is going to be 1,02,000. Now this 1,02,000 is the goodwill of the firm. We have to find the new partner's share of goodwill, that is S share of goodwill is equal to 1,02,000 into his share of profit is 1 by 5. So that is equal to 20,400. Now we need to pass the journal entries for this. First journal entry is there is a goodwill that is calculated. So we will find the first journal entry. The question says there is an existing goodwill in the books which is 50,000. So we need to first write off that goodwill. So how we will write off that goodwill? All the old partners capital account, P's capital account, debit, Q's capital account, debit, R's capital account, debit to goodwill. So what's the goodwill that is appearing in the books? It is 50,000. Now how we will distribute it among the old partners? It is in the existing profit sharing ratio, which is 5:3:2. So it's going to be 25,000, 15,000 and 10,000. So we have to write off the goodwill that is appearing in the balance sheet before admitting a new partner. So that is done. Now the new partner is supposed to bring in goodwill at he bought his capital. So bank account debit 30,000 to S capital 30,000. Now we calculate the goodwill that the new partner has to bring, which is 20,400, but he is not bringing it in cash. So what is the journal entry for that? It's going to be S current account debit 20,400 to sacrificing partners, to P's capital, to Q's capital, to R's capital. It has to be in the sacrificing ratio, which is 1:1:1. So it's going to be 6,800, 6,800 and 6,800. So we completed question number 30. So friends, please do subscribe to this channel so that you don't miss out further questions. Thank you.